This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's look at what these disallowed expenditures might include, and there are a lot of them. Now, the general rule is it must be wholly. Notice how that is spelt, which means totally, and exclusively, which means only. So that's the general rule for expenditure. It must be totally and only used for the purpose of trade. So there are things that will be in your expenses, in your financial accounts, which are not totally or only. For example, I'll give you a primary example. Shop, flat above, individual who runs the shop lives above. We get an insurance policy for the whole building, but half of that building is not totally or only for the trade because it's where the owner lives. So you would have to split that. Part of it is, you put all of it, the insurance is allowed for accounting purposes, but for tax purposes, the private part you have to pay tax on, and therefore it has to be added back into the trade profits so that that can then be taxed because he lives in that building. So here are some other ones that we need to be aware of. Capital expenditure. This is the main one that you'll come across. Depreciation is not allowed for tax purposes. Now it's a liable expense for accounting purposes, not a problem with that at all. But for tax purposes, it is wet your finger, stick it in the air, which way is the wind blowing? You as a business, you decide what rate of depreciation that you are going to charge against your capital assets. The revenue don't like that. So therefore, anything to do with depreciation has to be added back into your pro forma. Now you do get an alternative, and it's an alternative called capital allowances, which is in a different chapter. Those capital allowances are very strictly rules that the revenue have put in place. The revenue don't like depreciation because you make the rules. So they make the rules and you have to follow them. So repairs are allowed, but improvements, they are classed as capital and they are not allowed. Loan interest is not allowed. Qualifying loan interest payments are not allowable as they are dealt with separately. Okay, they are an allowable expense, yes, but not here. So debts are allowable as long as they are trade. If they are non-trade, you see the word non-trade, you have to adjust for it. It has to be added back. Entertaining is disallowed unless it is entertaining your employees. So entertaining clients, not allowed. Gifts to employees are allowed, but they may be assessed as a benefit, and you'll see that in a different chapter. Gifts to customers. There are some specific rules for gifts to customers. They must cost less than £50 per person per year. It cannot be food, drink, tobacco, or vouchers which are exchangeable for cash. And it should have an advert on it. Now, as we go through these rules, you'll think, I can never remember them. But as you go through the questions, you'll start to see a pattern evolving, and you'll start to think, oops, seen that before, oops, seen that before, oops, seen that before. If that's the case, deal with all the ones you've seen before. You'll then come across, there'll be a long list, maybe 15, 20 things. Probably 10 or 12 you will recognize because you've done them time and time again. Do those quickly. Okay, you're confident, you know what you're doing. The other ones, you go back and you think, now, is that capital? Is that wholly and exclusively? Ask yourself the questions and deal with them each one at a time. Donations, anything to do with the trade, that's allowable. Charitable donations must be small and local. So the local lads and dads football team, you are making a subscription or a donation, and in return they write your name on their shirt. Small, local. You won't have to determine what is small and what is not small, but local, you'll be able to tell by the wording in the question. National charities, not allowed. Okay. Charitable donations under gift aid, not allowed. You do get your relief by extending the basic rate band. If you look in the chapter about tax adjusted, about income tax, you'll see the information there about gift aid. You can also not have political donations. Legal and professional charges, they are allowable if they are trade, but not capital. Specifically allowed by statute or law is obtaining loan finance and short leases. Interest payable. So if you've borrowed money and you are paying back the interest and it's for trade purposes, it is allowed. Okay, it is allowed. Leasing cars. If the CO2 emissions is above 50 grams, then 15% of the lease charge needs to be added back. Now, there are lots and lots of these, but think of them in terms of categories or principles. 1, anything capital in nature is not allowed. Anything that is an estimate or a provision, so provision for debts, provision for depreciation, not allowed. Anything for sole traders or partnerships that's private use, living in the flat above. Anything that is not wholly and exclusively. Those are the main categories, and you can probably put any expense that you see in a set of accounts into one of these categories. Some more. Do you remember we talked about, in a previous chapter, we've talked about premiums paid on the grant of a lease. Okay, the premium itself is disallowed, and this is the amount. Do you remember we had landlord, tenant. Tenant pays the landlord in return for a lease of, say, 20 years. All of this is dealt with in the chapter on income tax. And then that for the tenant is spread over the number of years of the lease. Fines and penalties are obviously disallowed. Private expenditure we've just looked at. They're always going to find private expenditure, normally in relation to cars. Maybe it will be in relation to property, again, as I said, if somebody lives upstairs. Now, sometimes you will see in a question, it says the owner's salary. Now, that's not a real salary. That is actually drawings. And that definitely needs to be added back, and they need to pay tax on it. If it is a salary, it will have had pay-as-you-earn deducted from it, and obviously it's not the case. What's happening basically is that the proprietor, the owner of the business, is taking money out of it throughout the year because they don't want to have to wait 12 months in order to see how much profit they've made, to see how to get any money out. This is something that we see sometimes. Salary paid to a family member. So, for example, we employ Albert. We employ Albert to work Monday, Tuesday and Wednesday morning. Okay, does all the admin, does all the tea making, does all the odd jobs, and you pay him £12,000 a year to work Monday, Tuesday and Wednesday morning. Wednesday afternoon, Thursday and Friday, that's your son or your daughter. Now you're paying them £15,000 a year to work 2.5 days. That's not the going rate, because Albert's salary is the going rate. So that extra 3,000, you need to add it back, because basically what you're doing is siphoning your profits off through your family. Remember that one. Okay. Goods for own use. If you come across those, you must add back the item as a sale at market value, unless the owner's accounts for the goods in the business, and then you only add back the lost profit. We'll see that as we go through the examples. Pre-trading expenditure, you're allowed as long as it's allowed. So let's have a look now at a full example of how this works.